Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. You would think that at less than 10 times earnings, Intel would be a steal. Yet, its shares have languished between $45 and $65 per share since they acquired Mobileye in 2017. Which makes the news of Intel's decision to spin off Mobileye into its own publicly traded company through an initial public offering interesting. As the third most searched semiconductor stock amongst financial pros in the last 2 weeks, we decided to take another look at the perpetual laggard. And what we found was a stock with a lot of value and a reasonable pathway to growth. The question is, can they execute? As the world's largest semiconductor company and supplier of microprocessors and chipsets, Intel has struggled to keep pace in the last several years. The company relied heavily on personal computers, missing the mobile growth story. And over the years, Intel's vertically integrated business hamstrung the company as they lost focus on innovation, falling behind Advanced Micro Devices, who outsourced manufacturing. Last summer, Intel's stock sold off as the company disclosed a delay in the production of its 7-nanometer scale processor, putting it further behind Taiwan Semiconductor Manufacturing, which already mass produces chips at a 5-nanometer scale. The company announced plans to spend $20 billion to build 2 new semiconductor fabrication facilities in Arizona, giving them more production capacity in a tight supply market. And recently, Intel began to reduce its reliance on the client computing group for growth, as it hopes to take advantage of more profitable segments. Intel's revenues continue to grow, even in the client computing group. It's not as robust as AMD's or Nvidia's, but it's still strong. And Intel generates an insane amount of cash, like $34 billion per year in operating and $17 billion in free cash flows. When you look at Intel's valuation, it's hard not to wonder whether it's a value trap. That's when a company is barely growing, stagnant, or in a slow decline relative to the rest of the industry. According to these metrics, Intel is cheaper than the rest of the sector and itself over the last 5 years. That's why we think management's plans to shift their revenue streams are crucial to the company's future. In our opinion, we rank this stock at 8 out of 10. The current semiconductor shortage favors Intel and buys them time to execute on their transition to focus more on data centers. However, we want a nice margin of safety on this stock. So, we'd be interested in it below $50, ideally at $45. That would set up a nice dividend payment while we wait on their transformation. Click and subscribe to the Spill newsletter to get the full breakdown.